This is a demonstration of problem 19.4b. The accounting records of Pinecone Inc. showed the following data for 2020, and the problem gives us several different items that need to be considered in determining taxable income. It also tells us that pre-tax financial income was $460,000 and the tax rate is 30%. So the instructions state to prepare a schedule starting with pre-tax financial income in 2020 and ending with taxable income in 2020. So we're going to start with pre-tax financial income, which is $460,000. And we're going to consider each one of the items that are listed. The first item is they had life insurance expense on an officer of $7,000. So we know that life insurance expense is not deductible on the tax return. So that means that we are going to have to add back $7,000 as a permanent difference. The second item states that equipment was acquired in early January for $450,000. Straight line depreciation over a 6-year life is used with no salvage value, but for tax purposes, Pinecone used a 30% rate to calculate depreciation. So for tax purposes, 30% of $450,000 is $135,000. 450,000 divided by 6 for straight line is 75,000. So that means we have a temporary difference of $60,000 of additional expense for the tax return for depreciation. The third item states that they had interest revenue on municipal bonds totaling $3,600. So we know that municipal bond interest is not taxable on the tax return, so we will be subtracting that amount as a permanent difference. Number 4 states that they had product warranties that were estimated to be $90,000 in 2020. Actual repair and labor costs related to the warranties in 2020 were $24,000, and they expect the remainder is estimated to be paid evenly in 2021 and 2022. So for financial purposes, we would have deducted the entire $90,000. But for tax purposes, we're only allowed to deduct the amount that is actually paid. So that means we have $66,000 in warranty expense that was reported for financial statement purposes that is not going to be deductible on the tax return. So that means we need to add back that $66,000 as a temporary difference. Number 5 states that sales on an accrual basis were $500,000. For tax purposes, $400,000 was recorded on the installment sales method. So that means that we had an excess of $100,000 of sales reported for financial purposes that is not going to be reported on the tax return. So that means that we need to subtract $100,000 of revenue as a temporary difference. The last item says that we had fines that were incurred for securities violations of $10,600. So we know that fines and penalties are not deductible on the tax return. So that means we need to add back $10,600 for those fines and penalties to get to taxable income. So we have all of our total permanent differences of $14,000, and we had a total of $94,000 in temporary differences. Taxable income is $380,000. Our tax rate is 30%. So income tax payable for 2020 is $114,000. We can determine our deferred tax asset, which is equal to the product warranties that will be deductible on a future tax return, at times 30% would be $19,800 deferred tax asset, and then we would add together the excess depreciation for the equipment and the sales that were not taxable on the tax return. So those two together equal $160,000 multiplied by the tax rate would give us a deferred tax liability of $48,000. So now we are ready to record the journal entry for Part B for 2020 to record income taxes payable, income tax expense, and the deferred income taxes. So we'll start out with income tax payable, which was $114,000. Then we'll credit our deferred tax liability, which was $48,000. And then we'll debit the deferred tax asset for $19,800. And our income tax expense for this year, for 2020, would be $142,200. We could check that by going back to our intermediary amount after our permanent differences, $474,000. Multiply that by a 30% tax rate, and we would get the same amount, $142,200. And that is the conclusion of the demonstration for problem 19.4b.